Interest rates hitting 0% within the next 3 months. It sounds like a conspiracy theory, right? It sounds like something you would read on a fringe forum in the dark corners of the internet. But the math says it's almost inevitable. We are standing on the edge of a precipice, and the ground beneath us is about to crumble. Whether you have studied economics for decades in the ivory towers of academia, or you just read the headlines while sipping your morning coffee, the endgame remains exactly the same. We are all collectively holding our breath, waiting for the Federal Reserve to pivot. But here is the secret that the mainstream financial media won't tell you. The Fed isn't as independent as you think. It never was. Once that pivot happens, and it will happen, the money printers won't just turn on, they will go nuclear. Trillions of newly created dollars will flood the market like a tsunami. Asset prices, stocks, crypto, real estate, precious metals will likely skyrocket in nominal terms. The gurus and the financial advisors will tell you, invest now, close your eyes, wait 3 months, and get rich. They sell you the dream of easy wealth, but is it really that simple? Is it ever that simple? Let's peel back the layers and look at the real money trap that is being set for the average citizen. Economics 101 teaches us a very simple cause and effect relationship. When interest rates drop, borrowing becomes cheap. Businesses borrow to expand. Individuals borrow to buy homes and cars. Spending increases, and naturally, prices go up. That is the textbook definition of inflation. But look around you right now. Look at the real economy, not the stock market ticker. The Fed has signaled cuts, yet we are seeing a strange anomaly. Inflation is officially cooling down to around 2.7%, yet the economy feels frozen. Rates are arguably lower than their peak, but nobody is borrowing. Nobody is spending. The velocity of money is grinding to a halt. Why? To understand this, we have to look at the psychology of the saver. 2 years ago, the financial landscape was completely different. You could park your cash in a risk-free government bond or a high-yield savings account and get a guaranteed 5% return. It was the golden age of lazy money. You didn't have to be a genius, you just had to have cash. But now, that yield is evaporating before our eyes. It is dropping to 3.5%, and soon it will be much lower. Here is the brutal math that keeps the middle class poor. If inflation is officially 3%, and we all know the real rate is much higher when you count food, insurance, and energy, and your money sits in cash earning 3%, you are breaking even. But wait, you have to pay taxes on that interest. So, in reality, you are losing purchasing power every single day. Your $100,000 savings account might still show $100,000 on the screen, but in terms of loaves of bread or gallons of gas, it has become $97,000. It is the invisible tax. Previously, when the bank gave you 5% and inflation was 3%, you had a positive real yield. You made a profit of 2% just for breathing. It made rational sense to save, but the game has changed. If you want to borrow money to invest in a business or real estate today, the bank will charge you at least 6% or 7%. You start the game in the hole. The risk premium isn't worth it. This creates a fascinating and dangerous paradox. As rates drop from 5% to 3.5%, sophisticated investors aren't rushing out to spend money on goods and services. No, they are rushing to lock in yields. They are buying bonds. They are hoarding cash in fixed income instruments, trying to grab that last bit of interest before it hits zero. They are hoarding, not circulating. This temporary hoarding is keeping a lid on inflation numbers for now. It is the calm before the storm. It is a massive dam holding back a wall of water. But what happens when the bank rate drops below the rate of inflation? Imagine a world coming very soon where interest rates hit 0% or 1%, but inflation stays sticky at 3% or 4%. If you keep money in the bank, you are guaranteed to lose wealth. Mathematically, you are bleeding out. That is the tipping point. That is the psychological break. When the herd realizes that cash is trash, panic sets in. You are forced to withdraw your cash. You are forced to spend it on anything. A new car, a house, a Rolex, gold, Bitcoin, anything that will hold value better than the melting ice cube that is the dollar. You are forced to borrow at 1% to buy assets that rise with inflation. That is when the dam breaks. That is when the velocity of money explodes, and we go from controlled inflation to a hyperinflationary spiral almost overnight. Why would the government let this happen? Why would the people in charge, the supposed guardians of our financial stability, allow the currency to be debased? It seems incompetent, doesn't it? But what if I told you it isn't incompetence? What if it is a strategy? Ask yourself, who benefits the most when money loses its value? Is it the worker with a fixed wage? No. Is it the retiree on a pension? Definitely not. The winner is the biggest debtor in the world, the entity that owes more money than anyone else in history, Uncle Sam, the United States government. We are staring at a national debt of over $35 trillion. The interest payments alone on this debt are now higher than our entire defense budget. It is mathematically impossible to pay this off through taxes. You could tax every billionaire at 100%, and it wouldn't even make a dent. So, what is the solution? Default? No. That would destroy the global financial system. The only way out is financial repression. If the government owes $35 trillion and they manufacture inflation that makes the dollar worth 20% less, they have effectively wiped out 20% of their debt burden without paying a single cent. It is a default in everything but name. Lowering interest rates to zero reduces their interest payments on the debt, saving them hundreds of billions of dollars a year, enough to fund a war or a new social program. They need inflation. Inflation is the only way they survive. It's not a bug in the system, it's the main feature. But there is a bigger, more complex game being played on the geopolitical chessboard. This is a global currency war, silent but deadly. 2 years ago, when the Fed aggressively hiked rates, they weaponized the US dollar. They turned the dollar into a massive vacuum cleaner. Think about it. Capital flows to where it is treated best. When the US offers a risk-free 5% yield, while Europe and Asia are struggling, money leaves those countries and flies to New York. The high rates in the US sucked capital from all over the world, draining liquidity from emerging markets and allies alike. Why invest in a struggling Japan or a slowing China when you can get a guaranteed return in the world's reserve currency? Look at Japan. The yen crashed by 30% against the dollar. It was a bloodbath. But for American investors, it was a fire sale. Japanese assets, companies, real estate, labor, effectively went on a 30% discount for anyone holding dollars. This is why Warren Buffett, the Oracle of Omaha, loaded up on Japanese trading houses. He didn't just like the stocks, he liked the currency arbitrage. He borrowed cheap yen to buy assets that print cash. He bought them for pennies on the dollar. China faced the exact same pressure. The yuan devalued. Trillions of dollars worth of capital wanted to flee China to chase those juicy US interest rates. But China is different. China has a weapon that the West abandoned long ago: capital controls. They locked the doors. They built a financial Great Wall. The US strategy appeared to be crash the Chinese economy, force a liquidity crisis, and then swoop in to buy their distressed assets cheap. A repeat of the 1997 Asian financial crisis or the 2008 global meltdown. The Chinese real estate market did collapse. Evergrande imploded. It behaved exactly like a financial crisis. But here is the twist that frustrated Washington. China refused to open the floodgates. They let the internal market suffer, but they didn't let US capital in to buy the dip. The harvest failed. The hostile takeover didn't happen. Now, we are entering round 2 of this heavyweight fight. And frankly, the US is running out of stamina. Keeping rates high to pressure rivals is incredibly expensive. It's like holding your breath underwater to see if the other guy drowns first. Eventually, you need air. High rates broke U.S. regional banks last year. Remember Silicon Valley Bank? The Fed had to print emergency money just to keep our own banking system from collapsing. The cracks are showing in the foundation. Global strategists now see a reversal coming. China wants to reclaim that lost capital. If the Fed cuts rates and the dollar weakens, the yuan strengthens. If the yuan strengthens by 15%, all that money sitting in U.S. banks loses value overnight in exchange rate terms. It becomes a race for the exits. Smart money knows this. The moment the Fed cuts rates, the yield advantage, the carry trade, disappears. That massive pool of global capital currently propping up the U.S. economy, buying our stocks and funding our startups, it's going to pack its bags and go home. Here is the nightmare scenario for the U.S. Treasury, the one that keeps Janet Yellen awake at night. If foreign capital leaves, who buys our debt? Who buys the treasuries to fund the deficit? China is selling. Japan is selling to defend the yen. The BRICS nations are dumping debt. That leaves only one buyer of last resort, the Federal Reserve. This is the loop. The government spends money it doesn't have. It issues debt. Foreigners won't buy it. So, the Fed prints money to buy the government's own debt. This is called monetizing the debt, and it is the classic recipe for currency destruction. It is what happened in Weimar Germany. It is what happened in Zimbabwe. And it is beginning to happen here, just with more complex jargon. The government can't wait for the Fed to go through its slow, bureaucratic process anymore. They are getting impatient. They are rewriting the rules of the game in real time. Have you noticed the strange news coming out about Fannie Mae and Freddie Mac? Most people don't pay attention to these agencies, but they are the heart of the U.S. housing market. These entities hold the emergency reserves, the rainy day funds designed to protect the housing market from a crash. Recently, the administration effectively smashed the piggy bank. They are using these reserves to flood the market with liquidity, to artificially suppress mortgage rates without the Fed's permission. They are exploring caps on credit card interest rates. They are draining the Treasury General Account, TGA, to inject liquidity into the repo market. This is shadow QE, quantitative easing. They are bypassing the Fed to force the system to flush with cash before the upcoming election. They need the economy to look good at any cost. If you lived through the 1970s, this feeling of déjà vu is terrifying. Back then, the White House bullied Fed Chairman Arthur Burns to lower rates and print money to boost GDP before the election. They wanted a short-term sugar high, and it worked for a moment. GDP went up. Everyone felt rich. Unemployment dipped. And then, the hangover hit. Inflation exploded from 3% to 12% almost overnight. It destroyed the purchasing power of a generation. Unemployment followed as businesses couldn't plan for the future. It was a lost decade of stagflation. We are repeating history, step for step. The government wants a crash, or rather, what they call a controlled demolition. They want to inflate away their debt and reset the cycle. They need you to spend. They need asset prices up to tax the capital gains. They cannot afford a deflationary depression. It would bankrupt the state. So, what does this mean for you, the individual trying to navigate this storm? It means the era of safe saving